This week, Wall Street was a wild ride. Markets plunged and soared, leaving investors breathless. Each day brought a new twist, with headlines and breaking news sending shockwaves through the trading floors. The mood shifted from panic to hope and back again, as traders tried to make sense of the chaos. Volatility ruled, reflecting deep uncertainty about the future. The swings were dramatic, with some stocks tumbling in the morning only to recover by the afternoon. It was a week where fortunes were made and lost in a matter of hours, and every tick of the clock seemed to bring a new surprise. Investors weighed good news against bad, unsure whether to buy, sell, or just hang on. Economic data, earnings reports, and global events all played a part, making every decision feel like a gamble. Some clung to their positions, while others scrambled to adjust their portfolios. Despite the drama, the week ended with all major indexes, S&P 500, Dow, and Nasdaq, closing higher than they started. This turnaround surprised many, especially after such a turbulent start. The late-week rally brought a sense of relief, if only temporary, to those who had weathered the storm. This resilience shows that, beneath the anxiety, hope still drives the market. Investors are always searching for reasons to believe in a brighter tomorrow, and this week, that optimism proved stronger than fear. The ability to bounce back, even after sharp declines, is a hallmark of Wall Street's spirit. Like a tense basketball game, the lead changed hands constantly between pessimistic bears and optimistic bulls. Each side had its moment, with bears warning of trouble ahead and bulls betting on recovery. The back and forth kept everyone guessing, and no one could predict which side would win out. In the end, the bulls pulled ahead, pushing the market to a winning close. Their confidence, fueled by positive earnings and hints of economic strength, helped turn the tide. Even with questions swirling about interest rates and high stock prices, investors' appetite remained strong. Many are still willing to take risks, hoping for future gains, even as they keep a wary eye on potential pitfalls. The week's performance tells a story of a market wrestling with big economic questions, but not giving in to fear. Headlines about inflation, global tensions, and policy changes dominated the conversation. Yet the market's resolve held firm. The positive finish suggests investors are still betting on growth, even as they watch for risks. There's a sense that, despite the challenges, opportunity still exists for those willing to look beyond the noise. The journey was bumpy, but the destination, at least for now, was higher ground. For many, this week was a reminder that markets can be unpredictable, but also resilient. The market's ability to rebound in the face of uncertainty is a testament to its underlying strength. It's a place where optimism and caution coexist, and where every setback is met with determination to recover. Investors are nervous, but not defeated. They know that setbacks are part of the journey, and that perseverance can pay off in the long run. For now, optimism has the upper hand. The mood is cautious, but hopeful, as everyone looks ahead to what the next week might bring. The roller coaster continues, but this week, it ended on a high note. As the closing bell rang, there was a sense of accomplishment, and a reminder that, in the world of finance, anything can happen in just a few days. When we talk about the market, we're usually referring to three key indexes that act as the pulse of the U.S. economy. These indexes are like scoreboards, tracking the performance of thousands of companies and giving us a sense of how the financial world is doing at any given moment. The S&P 500 is often considered the best single gauge of the U.S. stock market. It tracks 500 of America's largest and most influential companies, spanning industries from technology and healthcare to energy and consumer goods. Because it covers so many sectors, the S&P 500 offers a broad, balanced snapshot of the market's overall health and direction. The Dow Jones Industrial Average, or simply the Dow, is the oldest and perhaps most iconic index. It follows just 30 major companies. Think Apple, Coca-Cola, Boeing, and other household names. These companies are leaders in their fields and have stood the test of time, making the Dow a symbol of American industrial strength. While the Dow isn't as comprehensive as the S&P 500, its long history and roster of blue-chip members give it significant symbolic weight. Investors often look to the Dow for a sense of stability and tradition, especially during uncertain times. The nasdaqcomposite, on the other hand, is known for its tech-heavy focus. It tracks over 3,000 stocks, including giants like Amazon, Microsoft, and Nvidia, as well as many up-and-coming technology and biotech firms. The Nasdaq is where innovation and rapid growth take center stage. Because of its emphasis on technology and growth companies, the Nasdaq is often more volatile than the other indexes. Its sharp ups and downs reflect the fast-paced, ever-changing nature of the tech sector, where fortunes can rise and fall quickly. Together, these three indexes give investors a multi-dimensional view of the market. Each one highlights a different aspect of the economy, from the stability of established giants to the dynamism of new technology. The Dow shows the stability and resilience of America's industrial and blue-chip companies, often weathering storms that shake other parts of the market. The S&P 500 offers a broad look at corporate America, capturing the performance of companies across nearly every sector and reflecting the overall economic climate. The Nasdaq reveals the momentum and innovation driving the technology and growth sectors, often acting as a barometer for investor appetite for risk and new ideas. By watching all three indexes, investors can better understand the market's complex forces and spot trends that might not be visible in just one index alone. This week, all three indexes ended higher, a sign of cautious optimism across the board, as investors responded to positive earnings reports and encouraging economic data. Despite their differences, the indexes moved up together, signaling widespread confidence and a sense that the market is moving in a positive direction. Investors are watching these benchmarks closely for clues about what's next, knowing that each index can tell a different part of the story. The market's mood is reflected in their every move, and by following these indexes, we can stay in tune with the ever-changing rhythm of the financial world. What caused this week's market whiplash? Investors and analysts alike have been left scratching their heads as stocks surged one day, only to tumble the next. The answer lies in a complex mix of hope, fear, and uncertainty that's gripping Wall Street. It was a tug-of-war between optimism and anxiety, with each side taking turns in the spotlight. Every headline, every rumor, and every economic report seemed to tip the balance back and forth. Strong corporate earnings and excitement about new technologies pulled the market up. Investors cheered as companies reported better than expected profits, especially in the fast-growing tech sector, fueling dreams of even bigger gains ahead. But worries about expensive tech stocks and uncertainty over the Federal Reserve's next move pulled it down. Many wondered if the rally had gone too far, too fast, and whether the Fed might spoil the party by keeping interest rates higher for longer. High-flying stocks like Nvidia sparked debates about whether prices have risen too far, too fast. Some investors saw opportunity, while others feared a bubble that could burst at any moment. Meanwhile, investors anxiously watched for clues about when the Fed might cut interest rates. Every statement from central bankers was dissected for hints, and even the smallest change in tone sent ripples through the market. Every bit of economic data and every Fed speech sent markets swinging. Inflation numbers, job reports, and global news all played their part in fueling the volatility. It's like driving fast in fog. Investors want to accelerate but keep tapping the brakes. The path forward is unclear, and caution is the name of the game. The result: sharp, unpredictable moves all week. One moment, markets soared on good news. The next, they plunged on fresh worries. This push and pull between hope and fear is fueling the market's volatility. It's a battle of emotions with each side fighting for control. Until there's more clarity, expect the roller coaster to continue. Investors are bracing for more twists and turns as they search for solid ground. The market is searching for direction, but the road ahead remains foggy. For now, uncertainty rules, and the wild swings are likely here to stay. Nvidia's meteoric rise is the talk of Wall Street. Its dominance in AI has made it a market mover. When Nvidia soars, the market often follows. When it stumbles, everything shakes. The debate. Are these sky-high prices justified, or is this another tech bubble? Bulls see endless growth from AI, while bears warn of hype outpacing reality. A single negative report sent Nvidia tumbling this week, dragging the market with it before a dramatic rebound. This Nvidia effect captures the market's current tension, optimism about tech's future, but fear of a painful correction. Every headline about these tech giants can trigger a buying or selling frenzy. The stakes, and the volatility, have never been higher. It's not just tech stocks. Cryptocurrency is adding to the market's wild ride. Bitcoin's price swings are now closely watched by Wall Street as a gauge of risk appetite. Sometimes, stocks and Bitcoin rise and fall together, amplifying market moves. Bulls see Bitcoin's growing acceptance and new investment products as reasons for optimism. Bears warn of its history of crashes, regulatory risks, and speculation. This deep divide makes Bitcoin's price extremely sensitive to news and sentiment. A single rumor or regulatory headline can send prices plunging. Crypto's volatility often spills over into traditional markets, adding another layer of unpredictability. For investors, it's one more reason to stay alert. The crypto craze is now part of Wall Street's daily drama. The biggest question on Wall Street: when will the Federal Reserve cut interest rates? High rates have cooled inflation, but also slowed economic growth. Lower rates would boost borrowing, spending, and the stock market. The Fed is sending mixed signals. Some data suggests cuts are near, others say inflation isn't tamed yet. Investors react to every new report, fueling market swings. The higher for longer fear keeps nerves on edge. Until the Fed's path is clear, volatility will remain the norm. The market is hanging on every word from the central bank. This week, a speech by New York Fed President John Williams gave investors hope. Williams said if inflation keeps falling, rate cuts would be appropriate. That was music to Wall Street's ears, sparking a rally. His comments signaled the Fed is open to adjusting policy as data changes. But Williams was careful. Rate cuts depend on continued progress against inflation. No promises, just possibilities. His words shifted the mood, but uncertainty remains. The market is watching for more clues. For now, optimism has a slight edge. Williams's dovish tone was reassuring, but the Fed isn't speaking with one voice. Other officials have sounded more hawkish, warning against cutting rates too soon. These public disagreements confuse investors and fuel volatility. Every speech or comment can send markets soaring or tumbling. It's like being on a ship with captains arguing over the course. No one feels secure. Investors crave clarity from the Fed. Until officials unite, markets will swing with every new hint. The drama inside the Fed is playing out in real time on Wall Street. For now, uncertainty is the only certainty. The market is left guessing which direction the Fed will steer next. Wall Street swings aren't just a game for traders, they affect everyone. Retirement accounts like 401ks rise and fall with the market, impacting millions of savers. A volatile week can shake confidence in those savings. The S&P 500, Dow, and Nasdaq reflect the changing value of everyday Americans' futures. Strong markets boost confidence and spending, fueling economic growth. Prolonged downturns can make people cautious, slowing the economy. Interest rate debates affect everything from mortgages to small business loans. The market's roller coaster is a mirror of the forces shaping our jobs, savings, and security. Understanding these connections shows why Wall Street's moves matter to Main Street. The stakes are real for all of us.